All right, the first one is an ICT bullish pattern number one. Okay, and the condition is the higher time frame has to be bullish, and the stage or the setup is price is going to bounce off of a higher time frame discount array. An impulse swing creates a fair value gap near the swing low. A short-term low forms in market structure and fails to rally higher after equal highs or a higher high is formed. Price will eventually drop down into the fair value gap and under the short-term low, forming after the impulse price swing forms. Sell stops are triggered. Smart money uses offset accumulation to pair long entries with the sell stop rate for a discount entry. This, to me, this is my fair value play or optimal trade entry. This is the actual optimal trade entry in great detail that wasn't explained when I was on the forums back in 2010. That overlapping with a fair value gap, a short-term low where the sell stops will be residing, and back into a bullish order block, you have four things going for you. If you have that with higher time frame bullishness, you have a lead pipe cinch doozy. If it's going to go up, it's going to go up really strong on this. It's not a guarantee. It's not guaranteed to go up. But I have learned in my own analysis, my study, that this is the criteria that works more than any other. This is a internal range liquidity range expansion trade. So in other words, it creates a range from the low at the order block up to the impulse swing and starts to retrace. While it's retracing inside that range, that's internal range liquidity going long inside that range with the expectation that it's going to expand outside of it. And I'm going to be targeting external range liquidity. Okay, the second one is the ICT bullish pattern number two. And I don't have any names for these except for just simply a fair value. And now this is a turtle soup or external range liquidity. The condition on the higher time frame is going to be bullish. And the stage or setup is this. Price will bounce prior to a predetermined or anticipated higher time frame discount array. Price drops lower into the anticipated higher time frame discount array at a later time and raids sell stops in the form of a liquidity pool. Sell stops are triggered. Smart money uses offset accumulation to pair long entries with sell stop raid, discount entry, ICT version of turtle soup. Whatever that discount array is that I'm really wanting to buy at, if price stops just short of it or above it and just hangs around and hovers or starts to move up a little bit, it gives the false bottom, a fake low. I won't buy that. I'm going to wait and see if they're going to run down and kill those early bulls. When it creates that short-term low ahead of the level I want to be buying at, everyone that bought it is going to have their stop loss in the form of a sell stop right below that short-term low. And I know that if it's going to go down to that lower time frame discount array, not lower time frame, but lower in terms of price, in other words, going lower than it has already, it reaches into a deeper discount, I should say it that way. I'm going to wait for it. In this case, I want to see a low form ahead of an anticipated level in terms of a discount. So say there's a fair value gap that I expect to see fill and price comes down, but it doesn't quite get there and starts to rally a little bit. I'm going to wait and see if they use that as a sucker play and then run one more time lower. When they do, I know those sell stops are going to be triggered. That's sell side liquidity hitting the marketplace in the form of sellers at the market. Smart money will accumulate that and accumulate those stops. I buy down there at the discounted rate because now I have a better feeling that price should rally because it's taken out stops. It went to my logical discount array, and this is turtle soup. And the bullish pattern number three, which is just basically the same pattern I've just shown you, but in the event that I did not get that entry down there on the turtle soup, which is the reason why I tell you, don't worry about it. If you can't get that level down there, fine. This is the pattern that I use. I wait for price to rally through the short-term high, and now that short-term high becomes a bullish breaker. When price trades back down to the breaker, I'm going to use that as my entry because I know that that stop run at the lower low, price should not come back down there. Usually isn't going to be a retracement down into a order block where the buy level is. So there may be a down closed candle down there, obviously. In many instances, many folks will look for price to trade back down there and get to that order block. That's going to be below the breaker. It's already been down there and it's done its work. So price is going to support around that bullish breaker. So I'm going to look at that level as my entry point. Now, in that impulse leg from where it says buy level up to the high and it pulls back down into the missed entry or pyramiding, that impulse leg right inside that upper portion of it as it trades from the bullish breaker, there's going to be a portion of price action in the lower time frame. So this is a 4-hour chart or an hourly chart. In this portion of the range here, that's going to be a lower internal range liquidity or optimal trade entry. You won't see it like this, but on a lower time frame, it'll be an optimal trade entry, and it'll trade into a lower time frame bullish order block or a lower time frame discount array like a fair value gap, and then price will expand. But you'll overlap with that bullish breaker seen here. Now, this is a pattern that is universal. Every pattern I'm showing you is universal. It can be seen on a monthly, a weekly, a daily, a 4-hour, 1 hour, 30-minute, 15-minute, 2-minute chart, 1-minute chart. It's universal. This is what I trade off of. So if I see this pattern on a higher time frame, then I start reducing it down and looking for the fractal of it just in a smaller time frame. Now, I've covered essentially just two patterns. It's the external range liquidity, or turtle soup, or internal range liquidity, which is optimal trade entry. I've shown you how if I got it wrong on the turtle soup and I miss it, I can now use the bullish breaker to get in sync with it. So I have a contingency plan for both patterns. It's either going to be an internal range liquidity, optimal trade entry, fair value play is what that is, or it's going to be an external range liquidity run, or basically it's turtle soup. If I miss the turtle soup, then I'm going to wait for it to go to the bullish breaker. That's it. If I don't see price doing these three things, I don't do anything. Okay, this is ICT bearish pattern number 1, and the condition is obviously higher time frame is bearish, and the stage or pattern is this. Price bounces off of a higher time frame premium array. An impulse swing creates a fair value gap near the swing high. A short-term high forms in the market structure and fails to drop lower after equal lows or a lower low is formed. Price rallies up into the fair value gap and above a short-term high forming after the impulse swing forms. Buy stops are triggered. Smart money uses offset distribution to pair short entries with buy stop rate. And this is bearish pattern number 2. And again, the condition is higher time frame bearish. The stage is, or setup is, price is going to bounce prior to a higher time frame premium array. In other words, you're expecting the price to come up a little bit higher, but it just falls short of it. Now, everyone else is going to get frustrated and chase price when it starts to drop, not you. We're going to wait for price to rally higher into the anticipated higher time frame premium array and raids the buy stop liquidity pool. Buy stops are going to be triggered. Smart money uses offset distribution to pair short entries with buy stop raid. It's a premium entry, ICT classic turtle soup entry. See, everyone used to ask, how do you know it's going to stop when it goes above the old high? Because you have to know the PD array matrix for that time frame you're looking at. Where are the PD arrays? What's the higher time frame? Obviously, we're in a bearish market environment. It's when we're looking for this. So I'll give you a scenario. Let's assume for a moment this is London. It's been going lower. It's now Wednesday. We have a high, and we started to drop down, and it started rallying back up. Okay, we run through that high at London Open. There's your turtle soup entry. It runs out buy stops. Price didn't trade up to a premium rate, enough of a deep enough retracement for you that you really wanted to key off of. Maybe it's on a 4-hour chart that you see this on, and you can anticipate that expansion down the whole 4-hour unfolding based on what you see here. But it's going to occur during London, or it could happen in New York. Say London is consolidation, and there's a news event that comes out in the 8:30 New York Open. Price runs up on that news, hits that premium array, and then you can sell short there and then get in sync with a nice day trade. Or many times, New York, if it's reversing, it can be a little bit longer term of a move. Okay, ICT bearish pattern number 3. So that run above that short-term high, tripping out buy stops, reaching the premium array that price was, and we were anticipating price to trade up to, but didn't do it on its first attempt, then it finally trades up to it. That's where I want to sell. But let's play devil's advocate for a moment and say I couldn't get it on, and price trades down through the breaker. Once the breaker is traded back up to, I can look to sell short there because my confidence level is very strong because the breaker has done its job. It ran the buy stops, and price will not want to give it an opportunity to go back up to that level. And don't think at this moment there's going to be an optimal trade entry near where it says the sell level, the higher premium array. That high down to the low prior to the secondary sell level, that won't be a range that needs to be retraced back to. They won't go that deep. Usually it's the breaker that stops it, and that's why I want to sell there. Now, if I was fortunate enough to get short at the higher premium array, I can look at that bearish breaker as an opportunity to pyramid. So if I went short 10 at the higher premium array, now I can sell short 5 at the bearish breaker and pyramid my position. Don't anticipate that being closed in or retraded back to for optimal trade entry, because to do so, you're completely avoiding and ignoring the bearish breaker that's staring you right in your face. So when I go through charts, the first thing I'm looking for in all my time frames is where are the breakers. Because once I understand that, that gives me immediate context to work within. Now, I can still screw it up, and you've seen me do it a couple times using the breaker in live session. But when I'm wrong, it gives me immediate feedback, and then I can get in sync with the marketplace again. So losing just gives you a premium insight. Don't try to fight that.